So yesterday our focus was on what? Adjustments. Right, who did their T accounts? Don't be shy. No one. Okay, one. Good. Okay. Right, I said it's not a must. See if you're able to complete it last night or this morning, but I do know that you guys are quite tired of listening to all the lessons. So anyways, we're going to start with the first question, the exam paper. Focus today is going to be the financial statements, where we complete income statement and balance sheet, and then we'll see if we get to your favorite topic, asset disposal. Yeah, I see some faces, concerning faces. We're going to go back step by step. How does asset disposal work? How does depreciation work? Right, but for now, let's have a look at the paper in front of you. So the whole purpose of this is to also teach you how to approach an exam paper. So, what do you do the 10 minutes when you've got reading time? What do you do in that 10 minutes? You start praying. What do you do? Seriously now. What part of the paper? Question paper or answer booklet? Okay. Right. Don't you think it will be better to look through the answer book? Okay. Why do I say that? Doesn't the answer book include all the questions? Yeah, it includes the questions. It will provide you with what is expected of you, the formats that you need to complete. Do I need to complete an income statement? Do I need to complete notes to the balance sheet? Do I need to complete the balance sheet? Okay, are they asking me to do ledger accounts? So you familiarize yourself by also looking at the question. You're also looking in the way in which they're asking the question. Okay, it's similar. It's exactly the same. And you can go and have a look. Compare question paper with an answer booklet. And you'll see that the information is on both. Okay, what else would you do? Once you started with the paper, what do you do? Now it's to start. What do you do? Come, I want to hear. Question what? Okay, so you start with the one you know best. 100% correct. You should know by the end of this year what is your strength and what is your weaknesses. Nobody says you have to start with question 1. Okay, so know your strength. Know which questions are you good at, which questions take you longer to complete, and then do those questions last. So what are your strengths? How do you find out what's your strength? Who of you study through old exam papers? Okay, now how do you study using old exam papers? Do you have the memo on hand? Do you time yourself? That's the first problem. You need to make sure when you study, you've studied the content of the work, the same approach that we're doing now, but then you actually test yourself by completing an exam paper. Okay, because that's the fact. If you complete a paper and you've got 6 hours to complete it, you are going to do much better than if you have 10 minutes. 20 minutes. So by working with a clock next to you, sticking to the time allocation, what are you doing? You're putting yourself under pressure as well. How to work with a clock next to you. How to actually move on and see, right, after 10 minutes, this is what I've completed. There's the memo. Now I start marking my own paper. And now I start identifying which are common mistakes. Because those common mistakes are the things that you work on a day before you write your exam. What's the point of studying things that you already know? Spending time on things that you already know. But if you know what is common mistakes you are making by working through old papers, those are the things that you focus on. It's the only way that you're going to learn how to manage your time, how to work in a certain amount of time. Because yesterday I said to you, how do you know how much time you've got for a question? You take the total per question divided by 300 times 180, because that's how long you've got in a paper. So it comes down to you actually have, it's 1,66 marks per minute. That's how long you've got in accounting. Okay. Now, when you get your paper and you start, instead of starting with a question, advice, go and complete your formats first. Why? While it's still fresh in your memory. Go and fill in your notes. Fill in the face of the balance sheet. Income statement is different. Why? Because I don't know yet which operating expenses do I need to include. Which operating income. I know the main part is sales minus cost of sales equals plus operating income equals minus operating expenses equals what do we add? Income. What do we subtract? Okay, those are the main parts of your income statement. Balance sheet, the face of the balance sheet won't change. I have non-current assets, current assets. Non-current liabilities, current liabilities. Owner's equity. Note number 1 up to note number 9. And you should know your formats. Why? Because number 1, it will help you to identify and classify accounts. Example, prepaid expense is classified as what? Okay, why? Because it forms part of which note? Note 5, trade and other receivables. Provision for bad debts is a negative asset. Why? Why? It is subtracted from your trade debtors in note number 5, which is your current assets. Accrued expense is a liability. Where do I find it in my financial statements? That is current liabilities, trade and other payables. So by knowing your formats will actually help you knowing which account is classified as what. Okay, so please make sure that you know your formats. Now, when you approach a question like this question and you get a pre-adjustment trial balance, the pre-adjustment trial balance consists out of what? The nominal account section and? Now, you should know all nominal account sections will go where? Where in my financial statements? Good. So your step number 1 is when they ask you to complete an income statement, everything from the nominal account section, take it to where it's supposed to go in the income statement. And write the totals in brackets from the pre-adjustment. Why am I doing that? 1, to get part marks. 2, all the information should be included. And thirdly, by doing that, I don't have to go back and check what was the balances or totals from the pre-adjustment trial balance when I complete the adjustments. Because the information is already written. Okay, so that's your first step now, which you are going to do for me, because they've asked you to complete the income statement. So everything from the nominal account section, take it to the income statement. Yes.
Okay.
What are you typicing out?
Put the operating, gross operating.
Oh.
Didn't realize this was the space for my other income.
Yeah. So start first with all the income. Now here's the question. Look at the information, how it's given. Did they tell you any of the balances which is on the debit and which is on the credit side? No. Which make it a bit more challenging. Because why? If I show everything on the debit side, you know immediately what is it. All expenses appears on the debit side. All income it will appear credit side. So now you need to sort that out. Which is income, which is expenses. Yes.
An imputed expense.
Where do you see that?
Because no, I'm just remembering from class, our teacher said depreciation is an imputed expense, and yesterday you said it's a negative asset.
No. Accumulated depreciation is a negative asset. Depreciation is part of operating expenses. Okay. No, it's accumulated depreciation. Don't forget to leave out a line before you write gross operating income. Just leave some space open, because what if there's a trading stock surplus? What if provision for bad debt adjustment is an income? Okay, so just remember to leave yourself 1 or 2 spaces open. Thank you. Right, who's still busy? Okay, no, it's fine. Wait, let me go that way around. The adjustments we're going to get to now. The first step is writing everything from the pre-adjustment trial balance that needs to go into your income statement. Write it down. Okay. If you are not sure, ask. Yes, the amount from the pre-adjustment trial balance, write it in brackets immediately. That's part of completing formats as well. When you're starting the question, that's your step number 1. coming? Yes. Good. And don't forget to write the amounts in brackets. Okay. Don't look at the adjustments yet. If you know, you can look. Are you done writing everything? Okay. First, write for me everything from the pre-adjustment. Right, we're still busy. Okay, 2 more minutes. Another thing you'll notice, based on the information given, that they tell you what is balance sheet account and what is nominal. So that's another reason why it's so important to know your basics. Right. You can finish the rest up in a minute. If you look at how the question is asked, what is expected of you to complete what? Is there any notes to the balance sheet? Okay, so when you're completing an income statement, do you care about the contra account if it's not an income or an expense? Do you care about the contra account? What happens to it? Okay, so is there any point in opening up T accounts and figure out, is it accrued, is it prepaid? Is there any point in that? Because I haven't asked you to complete that. The question is not requiring that. So yeah, it's simply a case of, do I add or do I subtract from that which has already been done? And that's why I say, write the amounts from the pre-adjustment trial balance, because those are the totals that I need to adjust. A lot of times we make a mistake and we only write the adjustment amount in our income statement. So instead of saying 22,000 plus 2,000, what do? You put the 2,000 in the income statement. This forces you now, I need to take the amount from the pre-adjustment plus the adjustment amount equals the final amount. Another thing, what if there was no adjustment with any of the accounts in the pre-adjustment trial balance? Do I leave that out or do I include it? You have to include it. So by doing this, first of all, you eliminate the chances of forgetting, oh yeah, I still need to include X, Y, and Z. Okay, so that just eliminates possible mistakes you can make. And another thing, this will earn you part marks, method marks, if you show what have you added it to. Okay. So please make sure what you've got to lose than to try doing this at the final exam. You have nothing to lose. So just give it a shot. Right, now, what else have you noticed now from this question? What we spoke about yesterday. What is in there which is normally a year-end adjustment? The norm is we do it at the end of the year. But now they've already included that in a pre-adjustment trial balance. The what? No, that will appear in a pre and a pre-adjustment irrelevant. Accumulate will be there. What? I heard somebody say? Profit on sale of asset. If I find profit on sale of asset and I find depreciation is another example in a pre-adjustment, it tells me that something has already been done. It's the same if I had asset disposal in a pre-adjustment trial balance. What is still left for me to do? What does that asset disposal in a pre-adjustment trial balance mean? It's the cost minus the accumulated depreciation. It's the book value. So you've basically done step number 1 up to step number 4. Only step number 5 is left over in asset disposal. So you can see asset disposal is involved. Calculating depreciation is involved in this question. So before we move on, I'm just going to revise asset disposal, calculating depreciation. Not a problem. So let's have a look. Right. You started with depreciation in grade 10, where depreciation was calculated on the old plus the new. Now, when calculating depreciation, there are 2 methods. It's 1, calculating it using the cost. Secondly, calculating using the book value. Now, the cost can also be known as the straight line method. Book value could also be known as diminishing balance method. So calculating depreciation on the old plus the new using these 2 methods were taught in grade 10. So what if we added in grade 11 is when we sell one of our assets as well. So now I need to calculate on the old, the new, plus that which we sold using either one of these 2 methods. Right, very important. When we're calculating on the old, we look at the remaining. What did we have since the beginning of the counting period until the end of the counting period? So if I draw this on a timeline, if our counting period ends 28 February and it starts the 1st of March, we look at what was our depreciation on the remaining for 12 months. You let me write it. When we're calculating depreciation on the new, it's from the day we purchased it until the end of the accounting period. So the new, from day of purchase until the end. So does it matter if it's cost or diminishing? Why not? It's true, but I just want to know, do you know why? One of you two? there's no accumulated depreciation. It's the first time that we are calculating depreciation on that item. So when we calculate on the new, it's irrelevant if it's diminishing or cost. It's from the day we purchased it until the end of the counting period. Right. When we calculate on that which we've sold, it's always from the beginning of the counting period until the day of which we sold it. Okay. When we sell it at the beginning of the counting period, do we calculate any depreciation? No. When we sell it on the last day of the counting period, can we actually calculate the old plus what we sold together? Yes, because it was for how many months? For 12 months. Anything less than that, if we sold it halfway through the year, 2 months into the year, 8 months into the year, we have to do it separately. And that's why when you calculate on the old, the remaining, if you do it separately, it is always going to be the cost minus the cost of the asset disposal. Because I need to take that out of the equation. Why? Because I've already calculated depreciation on that item. Secondly, if I didn't have it for 12 months, I can't calculate it for 12 months. So when we get the remaining, it's always the cost in the beginning, or the cost, the balance at the end, whatever the case may be, minus the asset, the cost of that which we sold. This is using cost. I will go in more detail later on with the notes specifically. When we're using diminishing, we need to do the same. It's the balance in the beginning minus the balance in the beginning on the asset which we sold, to get the value, the book value of the remaining, that which we had since the beginning of the counting period until the end of the counting period. So what are we actually doing? We're just taking asset disposal out. But if we're using book value, we need to also look at, but what is the accumulated depreciation without the asset that we sold? And what is the biggest reason for this? What is the biggest reason for this? Because we've already calculated on the asset which we sold. We can't include it again, otherwise I'm going to add it twice. Okay. So these are the fundamentals that you need to remember when you're calculating depreciation. Old plus new plus sold. Advice, write your calculations in an orderly manner, old, new, sold. The old plus the new is always added together. Why? When we show the depreciation, the old plus the new is always added together. Why? We calculated for the 28th of February. If I show depreciation, if we sold it halfway through the year, wouldn't the date be different? Okay, because that's what you need to remember with asset disposal. We show when we sold the asset on the day which we sold it. So that's why it is shown separately. I would have in accumulated depreciation, balance brought down, depreciation. Why? If it was sold on a different day, it needs to be shown on that day in which the transaction occurred. Okay, right. So now, if we look at, there are 5 steps in asset disposal. Step number 1, and I show it on T accounts. Where do we always show the cost of the asset that we purchased or sell? In? I can't hear. Yes, but which account? We're getting to that part. Let me ask you, any cost, if I buy an asset, if I sell an asset, where do we show the cost? The original cost, the historical cost. In equipment or land and buildings or in vehicles. These accounts will always be at cost, vehicle or equipment. We always show the historical cost. That's the GAR principle being applied. So, all the depreciation accumulated over the years will show where? In accumulated depreciation on equipment or vehicles, which is also a negative asset. So, let's just say I've got one asset. So the balance brought down is that of one asset. Now I decided to get rid of that asset. So what needs to happen? Forget about debit or credit. What do I need to do? I need to take it out. And where do I need to take it out to? Asset disposal. Asset disposal is an account opened and closed. It can either be treated as a balance sheet account or a nominal account. But it's opened and closed on the day of the transaction. So if I take out the cost, that is your step number 1, take out the cost, where to asset disposal. So I would always have the cost, which is equipment or vehicles, I would always have on the debit side of the asset disposal account. Step number 2, update the depreciation on the asset which I sold. So how do I update my depreciation? I need to calculate depreciation on the asset which I sold from the beginning of the accounting period until the day that I have sold it. So when we show depreciation, step number 2, which 2 accounts is involved? Depreciation, which is an expense, and accumulated depreciation. So this is step number 2, update your depreciation. For every credit, there's a debit. And that would be on vehicles or equipment. It applies to both. Right, third step. Take out the accumulated depreciation out of the accumulated depreciation account. Where to? Asset disposal. Now some might say, but how do I take everything out? What about the depreciation that's been calculating? What's the point? Isn't it still included in my depreciation account? Part of my expense? Where would I close that account off to? Profit and loss. It will appear in my income statement. So although I'm taking out the total accumulated depreciation, I'm still including that part from the beginning until the day that I've sold it. I'm still including that as an expense to the business by showing it in my depreciation account. Right, so when I take out the total accumulated depreciation, it means that accumulated depreciation on vehicle and equipment is debited. Which account is credited? Asset disposal. This will always be beginning plus updated. Right. Now, that was step number 1. This is step number 3. There's step number 2. Step number 4 is record the selling price. Now, to show the selling price, asset disposal account will always be credited. Now, there's a reason I'm writing it like that. Why? What is the contra account? It depends on how did I sell it. If I sold it cash, what would be the contra account? I'll be with, yes, correct. If I traded it in, if I sold it on credit, if a partner took it over. Okay, can you see? Irrelevant asset disposal is always credited with the selling price. My details, the contra account, will depend on how did I actually sell it. How did I get rid of it? So there are other things that can happen as well. What if the car was actually, a vehicle was stolen and the insurance company is paying you out money or going to pay you out money? So you just need to work through papers to see the different possibilities in which it actually can be asked. But it gets more complicated in grade 12 because we do similar work in grade 12. So you can expect by the time you get to grade 12, it will be more difficult. Right, now, step number 5, calculate if I made a profit or loss in the sale of asset. So cost minus the profit or loss on the sale of an asset will always appear in your income statement. If I made a profit, it will appear on the debit side. It means sold it more. Or you can just balance the account. If I sold it for less than the book, step number 1, take out the cost. Where to? Asset disposal. Step number 2, update your depreciation from the beginning of the accounting period until the day that you sell it. Third step, take out the total accumulated depreciation. Where to? Asset disposal. So if I say total, it's beginning plus updated. Step number 4, record the selling price. Asset disposal is always credited with the selling price. And then step number 5, calculate if you made a profit or a loss on the sale of the asset. So now we go back to this exam paper. What have they already done? So now I am going to focus on T accounts just to make 100% sure that you understand the question. So when you practice for the exams, you don't do T accounts. See if you can do it in the prescribed time. So if you have a look, I've got profit on sale of asset. Now, do you think that will have an impact on the balances in the beginning for equipment and accumulated depreciation? Yes, because that is after we've done step number 1 and step number 2. Those are the balances from the pre-adjustment. So it could happen in an exam when you do the tangible asset note. You have to work your way back to actually find out what was the balance in the beginning. It's the same as with the cost account. In the pre-adjustment means they've already done step number 1. So that's after they've taken out the asset disposal. So what is your balance in the beginning then? Okay, that's what makes this topic difficult, especially also when you buy a new asset. Has it been recorded or has it not yet been recorded? Because that makes a difference. Is these balances the balances in the beginning or is it the balances at the end? Because that has an impact on how do I calculate depreciation on the remaining. Because I need the balances from that which I had since the beginning. Okay, so please make sure, be aware of these sort of things, that you actually understand what to do. Sometimes I say it's better to do T accounts when it comes to depreciation. Do the cost T account just to make sure that you know what was the balances in the beginning, what is the balances at the end. Right, so let's have a look at the adjustment. Fixed asset, equipment. On the 1st of May 2010, an old office desk with an original cost of 3,600 was sold for 2,500 cash. The accumulated depreciation on the desk on the desk that was sold was 1,200 in the beginning of the accounting period. The accounts clerk recorded the transaction as reflected by the following asset disposal account. So they did step number 1. They did basically everything, didn't they? So let's read additional information. On the 1st of June 2010, Shark Traders purchased additional furniture from Leslie Suppliers for 8,000. This was not recorded, and equipment is depreciated at 15% per annum, diminishing balance method, carrying value. So, out of these 3, what have they done? I'm listening. What is it that I need to do? Why did they give me all of this asset disposal and all of this information? What is it that I need to do? Come, say, hands up, say. Who's got an idea? Yes. On what? But I need to do it on equipment as well. So what they've done is they've done on that which we sold. We still need to find, we didn't buy new equipment, but is there remaining? Is there old equipment? So shouldn't we work out the depreciation on that? So, how do I find out what was the balances in the beginning? So I'm going to show you T accounts. Just want to take this out, it's easier. Do you understand what to do with this question? More or less. Okay, let's do it step by step. So first, this is what I refer to. They have done step number 1, if you look at the information, the asset disposal account. They have taken out the cost to the asset disposal account, which means in equipment, they've already done the 3,600. So that balance from the pre-adjustment trial equipment 1,000. Is this before or after the 3,600? After, because I've already done that. So it means that 31,000 sorry, thanks. It means that 31,000 is after they've taken out the cost of the asset which I sold. So what is my balance in the beginning? So balance brought down means balance carried. So what do I need to do? I need to add those two together. What was the cost in the beginning? So what was the cost in the beginning? I can't hear. $30? No, did you add the two? You have to add the two. It is 34,000. There you go. Remember, we have to calculate depreciation on the old, the new, plus that which we sold. So they've already done that on which we sold. Now we need to find out the remaining, and if there were new equipment purchased, we would have needed to work that out as well. But now, calculating depreciation on equipment, do we use diminishing or do we use the cost? What does diminishing mean? So it means I need to do the same now with accumulated depreciation. Accumulated depreciation on equipment, that balance brought down is not the balance in the beginning. Why? If you look at the adjustment, they've already done what? They've already done step number 3, taking out the total accumulated depreciation. So if asset disposal is credited, it means that accumulated depreciation was debited with 1,200. So it means that the balance from the pre-adjustment trial balance is actually the balance after the asset disposal has been taken out. So what is the balance from the pre-adjustment trial balance? 14,500. Balance brought down means balance carried down. So what is the balance in the beginning? What do I need to do? I need to add everything on the debit side. So what is the balance in the beginning? Say again? Correct. Okay, that's the difficult part from this question. Calculating depreciation is the easy part. Finding out what figures to use is the difficult part. Right, now, my accounting period, if it ends 28 February 2011, it means it starts when? 1st of March 2010. This asset was sold on the 1st of May 2010. Why do I care about the depreciation on the asset which I've sold if they've already done the asset disposal account? What's the link? Tell me, from the pre-adjustment trial balance, is there any depreciation account there? So shouldn't I include in the depreciation sold, old plus new? So I still need to work out what was the depreciation. That's why they've given me enough information to actually work it out. So if I just work out the depreciation on the asset which I sold, it means that book value, what was the cost? 3,600. Right. What was the cumulated depreciation? That was the total, wasn't it? What did they say? Let's read. Oh, they did say, sorry, the accumulated depreciation on the desk was sold for 1,200 on the 1st of March. There's the 1st of March. So can I take minus 1,200? Yes. So what is the book value? Now, can I say times what percentage? It's 15%. How many months? March, April. Do I count May? So how many months is it? So what is my depreciation on the asset which I sold? So my first entry in my income statement for depreciation is 60. So write it in brackets. In your income statement, depreciation, what is your first entry? 60. Right. What makes this easier, getting the remaining, is there any calculation with taking out anything or working backwards? Why? Isn't that after it's been taken out, the cost? Isn't that after they've taken out the accumulated depreciation? Yes. So to work out the depreciation on the old, we're going to say 31,000 minus 14,500. Why? Because we need the book value. What is the book value? Good. So 16,500 times 15%, what is the depreciation on the old? And where must that be added? To your depreciation account. So go to your income statement. What do you need to add? 2,475. Right. Next. Do we have a separate depreciation account for vehicles? No. For anything else? No. There isn't a separate account. There's one depreciation account. Now let's see, is there anything else that we need to work out? Yes, on the 1st of June, Sharks Traders purchased additional furniture from Leslie suppliers for 8,000 on credit. That part is very important. It says this was not recorded. So it means furniture forms part of equipment. It's not a vehicle. It can't be land and buildings. So what else does it form part of? Because it's a long-term fixed asset. It forms part of your equipment. Because they said this has not yet been recorded, it means I still need to add 8,000 to the equipment account. But they haven't asked you to complete balance sheet. It's just so that you know for in the future. So you would have needed to calculate your balance in the beginning as well as your balance at the end. Does diminishing balance method matter on the new? No. So to calculate on the new, I have to say 8,000 times 15%. When did we purchase it? On the 1st of June 2010, which means from the day we purchased it until the end of the accounting period is how many months? Good. So what's your final answer? What's your answer for depreciation on the new? What did you get? That's correct. So now you need to add another 900 to your profit, to your operating expense. So what is the total depreciation for this year, which is closed off to your profit and loss account, which is the amount that will appear in your income statement? Can't hear? 3,435. That's your depreciation. So this would have taken a bit of time. Pointers. What did I need to do? Say again. What was the things that you need to remember for in the future? What is it that you need to be aware of? Okay. One, there was no depreciation from the pre-adjustment trial balance, even though they've done the asset disposal account, which means we still needed to calculate the depreciation on the asset which we sold. It still needed to be included. Point number two, because they've already done the asset disposal, it means that we needed to find out what is the balances in the beginning. Now, you can do your calculation as you wishes when you do an exam. Nothing prevents you from opening up a T account. You do not need to write the details in full, the account name. You do not need to take a ruler and draw a perfect T account, because that's just a waste of time. The only thing that you can put in is the amounts plus or minus on top of the T account to know what should I add, what should I subtract. It's the only thing you need, because we don't mark your T accounts. I actually don't care about that calculation. I care about that depreciation, and you'll see when I give you the memo, that could easily count 1, 2, 3, 4 marks, easily. There was a lot of calculations involved. So it's important to show everything in brackets. Okay, we don't mark your workings. We mark what is on your income statement. Right, any questions? Just remind me the 5 steps of asset disposal. Step 1. Step 2. Step 3. Step 4. Step 5. Calculate profit or loss. So now I see that some of you, that all of you would have actually had in your income statement profit on sale of asset, and it's in brackets. You can immediately close that bracket and write it as your final amount, because you didn't need to make any changes with regards to that. Right. Next. A further 320 must be written off as irrecoverable. This is what I spoke about yesterday, bad debts. And then what comes after that? Provision for bad debts. So they've only asked you to complete income statement. Do we care what happens to the debtors control account? In this case, we do. Why? Because they've asked you to calculate it 5% of the debtors. So it means my new debtors control balance should be used in order to calculate that 5%. So draw a T account, open up debtors. So debtors control is an asset. We have the balance brought down on the debit side. So from the pre-adjustment trial balance, the debtors has a balance of 16,540. Again, it's not even necessary to write that in your T account. I'm doing it for explanation purposes, that you know where it comes from. Now, if we have to write off an account as bad debts, what do we do with debtors control? We have to minus. Our assets will decrease because we're not going to get that money in. By how much? 320. So now immediately go to your income statement. What should be added to bad debts? So go put plus 320. Why not? Because it's added to my expense. And if you are, she's got actually a good point. If you are ever unsure, should I plus or should I minus? Bad debts is an expense. For every credit, there's a debit. So should we add or should we subtract? We have to add it to the total from the pre-adjustment trial balance. Double entry principle, credit, there's a debit. So it should be added. Right, now, I just draw a double line. Then I work out what is my new debtors control balance. Debit minus the credit side, what is my new balance? It's 16,220. And what do we need to times that with? 5%. So then I'm not going to write all the calculations down. I'm immediately going to take it to provision for bad debts. And I'm going to say, my new total for provision for bad debts is supposed to be? Correct. What is it from the pre-adjustment trial balance? Do we need to make it more or less? So if we make it less, provision for bad debts adjustment is an operating income. So what is the difference? So now go immediately to your income statement. Provision for bad debts adjustment is an operating income. You don't need to spend unnecessary time writing every single answer down in your calculation. Be smart in the way that you do it. By doing it in this way, on your answer booklet, you're also showing me your calculations. There I can see immediately, how did you get bad debts, the total? How did you get the provision for bad debt adjustment? Right, can we move on? Inventory, the next one. The annual stock take on 28 February 2011 determined that 22,120 worth of trading stock was on hand. So this is quite easy. All I need to do is I need to compare it to the trading stock in the balance, in the pre-adjustment trial balance. There were no adjustments. Some learners prefer doing the following just to make 100% sure. So according to the pre-adjustment trial balance, we have trading stock with a balance of 23,450. According to the physical stock count, it should be 22,120. Clearly, there is stock missing. Why? Because what we physically counted is not the same as what our balance is showing us. So if I need to balance this anyways, where do I put the difference? On the debit or on the credit side? So for every credit, there's a debit, then trading stock deficit, it's an expense. It will appear on the debit side. Okay, so what is the difference? 1,350. So it means trading stock deficit forms part of your operating expenses. So you can show your workings, but normally this would be an accuracy mark because there wasn't anything difficult to this adjustment. It was just a case of adding up or subtracting correctly. So you could put the balance in the beginning minus the balance at the end as your workings in brackets. Right, now, unused consumable stores amounted to 1,120. Yes? Yeah, of course. Say again?
You see the provision for bad debt that we just calculated in our balance sheet when we go to one of the notes where we say...
You'll take the end total, the new one. Yeah.
Oh, okay.
Yeah, because you needed to adjust that. Okay. Right. Now, consumables, whatever is left over is always subtracted from our expense. This is the non-negotiable that all of you should be getting full marks for. When they say there is leftover from consumables, packing material, you go immediately to consumable stores and is subtracted. We haven't used all of it, so it will decrease our expense. That's why we have to subtract it. So immediately go to your income statement, where you've written in brackets, consumable stores. What do you need to minus from that? 1,120. Right, just for future reference, whatever you physically counted is always your final amount in note number 4 as your trading stock. You don't even need to show any calculations, and you can get full marks by just doing that. What you physically counted is always your final figure that appears in your note number 4. Right. Next one, interest. Interest on loan must be taken into account at 12% per annum. Note that the 5,000 of the loan is paid on the 1st of September each year. So this means that I cannot take the amount from the pre-adjustment and just calculate it for 1 year. Why? Because 5,000 is paid on the 1st of September each year. So if I have my accounting period, which ends 28 February 2011, and it starts the 1st of March 2010, and we indicate on the 1st of September each year how much is paid back. So the balance from the pre-adjustment trial balance, is that the balance in the beginning or the balance at the end? It's the balance at the end. So what is the amount from the pre-adjustment trial balance? So basically from here, what is the amount? We are busy with loan, 20,000. Good. So what is the balance in the beginning? It should be more because the loan was paid back. So now interest should be calculated on 25,000 at 12% for how many months? From March until September is how many months? And then I have to calculate on 20,000 times 12% times. Right, so 25,000 times 12% times 6 over 12 equals 1,500. 20,000 times 12% times 6 over 12 equals 1,200. So what is the total interest for this accounting period? Okay, but now if you look from the pre-adjustment trial balance, interest on loan is an expense which has a total brought forward of 2,000. So what is it that I'm supposed to do? Okay, I've just calculated what my interest is supposed to be for this accounting period. The difference is equal to how much? Which means that is still outstanding. But for the purpose of this question, for this exam question, do I care about that 200 if it's accrued expense or is it added to the loan account? Okay, I don't care. They haven't asked me to complete the balance sheet. What you've done is actually, you could immediately have taken that 2,700 to your income statement, because that's your interest that's supposed to be for this year, 2,700. So now in brackets you would have a calculation, 2,500 plus 200. There are many different ways in which they ask interest. Another way is by giving you a loan statement and saying interest is capitalized. The monthly repayment of the loan was X amount times 12, so work out the interest for the year. Okay, so we're going to look at those sort of things as well when we work through more papers. But any questions here? Do all of you understand what you needed to do? Again, we don't care about the 200 where we need to take it. They've only asked me to complete the income statement. You are supposed to show in your income statement all your income and expenses for 12 months. Right, next one. Yes. How would you show it? So you would have in your income statement, you would have net profit before interest expense. Then you would have interest expense. So in brackets, you will have 2,500 which you've written, and now you will just add 200. Okay, remember there could be interest on bank overdraft, interest on overdue creditors account. All of that forms part of note number 2. Okay, so just be aware just before you write final amounts in that there's no other adjustment where interest expense is involved. So just don't be too quick to close the brackets. Right, next one, the fixed deposit was invested on the 1st of December. What do I need to do? There you go. So now, again, if my accounting period ends 28 February 2011, and this fixed deposit was invested on the 1st of December, it means I need to calculate interest on the fixed deposit for how many months? December, January, February. That is 3 months. So now where do I find additional information? Go to the pre-adjustment trial balance. It says fixed deposit, 8,000 was invested at 13% return on the investment. For how many months do we need to calculate the interest? For 3 months. So what is my total interest on the fixed deposit? No, what did you get? 260. Right, but now again, there's interest on investment, interest on fixed deposit. It's an income. We have a total brought forward of 200. If my interest is supposed to be 260, how much is still outstanding? Right, again I'm going to ask the question, do we care about that 60? You could have immediately taken that 260 to your income statement because that's the interest for this accounting period. Okay. Interest, the percentage is always per annum. So always remember to write out times 1 over or 2 over. For how many months do I need to calculate it? Okay, next. The rent for March 2011 was received and deposited. So March falls outside of our accounting period, yes or no? So this is one of the easier adjustments which we've done yesterday. Why? Because they didn't say there's a monthly increase or decrease. Nothing. So I can just take in your income statement, what is the amount from the pre-adjustment divided by, that gives you how many months should be taken out, 1 month minus the amount which you get. So it's not necessary for any T accounts, for anything, calculations, because they said 1 month was received in advance. It means 1 month should be taken out. Right. The last adjustment, a quarter of the insurance expense relates to the next financial year. So now it's just asked slightly in a different way. What do I mean slightly in a different way? We used to, they telling us the insurance was paid for per annum on the 1st of December, so now we need to work out the months that we need to take out. Okay? Here they just say a quarter of the a quarter of the insurance expense relates to the next financial year. So go to the pre-adjustment trial balance. What is your insurance? So how much do I need to take out? So you just minor, work out a quarter from that total. Okay, so what is your final amount? Now you're done with all the adjustments. Now we can close all the brackets. Finish the income statement for me. Can I give you 2 minutes to finish? Don't forget, anything that's subtracted must be shown in brackets. So you draw a block around all your operating expenses, and next to operating expenses you can write it in brackets. No brackets, you lose the mark. What did you do with debtors' allowances? It's always subtracted from sales. That's the first closing transfers. It's never shown separately. Done? So busy. Done. Hello? Yes. Let me just switch this on.
you say operating profit before interest expense and then net
Plus
profit?
interest income equals net profit.
No,
No,
the wording, the
operating.
wording.
Yeah, operating profit before. That's operating profit. Yeah, you can write before interest income.
And then after
That is operating profit before interest expense.
Okay. I just wanted to know the wording.
Okay. Right. Are you guys sorted there? Are you? What is there a difference in your answers? How is that possible if we've done everything together? What have you done?
I changed that one to yours. Are you serious?
Okay, so the 17.
Just your instinct. Okay, sorted. Right. Let's move on. We will mark everything later on. Next question. Focus is partnerships, financial statements. So what do? When you get your question paper, what are you going to read? Your answer booklet, or you're going to look at your question paper? Okay, good. So it's clear by looking at the answer booklet, what are they asking you? They are asking you to complete notes to the financial statements, and they are asking you to complete the face of the balance sheet. Right? So now, after you've done that, you can go to your question paper, and now you start with the formats. So, there's a list of balances amongst others. So while you're completing your format, can we take those lists of balances to the balance sheet and to the notes? Okay, but what do you need to be careful of? Who's to say vehicles and equipment is the balances in the beginning? What if new assets were purchased or new asset was sold and this has been recorded or has not yet been recorded? So just be careful. If you look at capital, and that's another thing, capital can be contributed during the year and capital can be taken during the year. This could have been recorded or could not have been recorded. So will that necessarily be the balance in the beginning? No. Okay, so just be careful with certain items. So what is a non-negotiable? What will not change? Irrelevant of the balances. The face of the balance sheet. So go to the face and complete your formats. On the face of the balance sheet, non-current assets consist out of tangible assets plus. So write in. Current assets consist out of note number 4, 5, and 6. Keep that order. What's note number 4? Inventories. Note number 5. Trade and other. Receivables. Note number 6. There you go. Right. Owner's equity, partner's equity, we spoke about this yesterday, consists out of which two accounts? Okay, now have they asked you to complete the capital account? That's why you familiarize yourself. Have they asked you to complete it? So you would have to take the amounts from the pre-adjustment trial balance and write it as calculations in brackets. Okay, just keep that in mind. Current account, have they asked me to complete the note? Okay, so you don't fill anything in there. You first have to complete the note. Right, non-current liabilities consist out of what? Write it in. Do you have to write the loan, the bank name? Yes, because what if I've got different loans from different places? current liabilities consist out of what? Note number 9, trade and other payables, and what can be shown separately? Bank overdraft, current portion of loan. But we don't know yet if there is a current portion of loan. Yes. Right. Now, from the pre-adjustment trial balance, which amounts can I already complete on the face of the balance sheet? So let's have a look. What does inventory consist out of? Consumables on hand and? So go and look. Is there any trading stock? Is there any consumables on hand? And write it in brackets. Right. Have they asked us to complete note number 5 and note number 9? Okay, so I'm not going to write those totals in the pre-adjustment chart, in the face of the balance sheet. Where am I going to write it? In the notes. So now if you go and look on your answer book, they've already taken debtors control. They've already taken the creditors control total. So do not add it again, please. And if you're working against time, you are rushed, we do make silly mistakes like that by completing it in, filling it in again. Okay, so just be aware, that's why you can also tick off what already appears in your financial statements, that you make sure you don't leave out anything or add something twice. Right, now that we've done that, when does our accounting period end? Familiarize yourself with the counting period. When does it end? 28th February. When does it start?
1st March.
So I see a date there which says current account, 1st of March 2014. You should know immediately, where do I need to take it? To the note. Where in the note? This is why you need to know the formats. And I'm going to show you how to learn your formats for the note. Yesterday I said to you, what is a partner entitled to? I'm listening. That forms part of what? So that's the first part of your note. It's salary plus bonus plus interest on capital, and then you would have for partner A, partner B, and the total. It's an example. What does that equal to? Primary distributions of profits. This is your current account note. The remaining is shared according to a specific ratio. That remaining is called what? So, plus final distributions of profits equals the net profit for the year. Now the formats can differ slightly. That net profit per income statement can also appear on top. It can either be down here or it can be up there. What format do you use at school? Bottom, okay. Be aware it could also appear here, net profit per income statement. Right, now, what is always closed off to the current account. Okay, so that is our next step. Drawings is always subtracted, so that's why it is in brackets. Then, what do we get? Net profit for the year minus drawings equals retained income. Let me rather write it out. Retained income for this year. Now, the next step is the retained income. This can be plus or minus. It depends. If my current account, it's an owner's equity account, if it has a debit balance, it is always minus because it's negative. If it has a credit balance, it is always positive. Then we have to always add it. So retained income for the year plus or minus retained income equals retained income at the end of the year. That's beginning and that is the end. So this is how the note actually works. If you do a current account, ledger account, T account, it is exactly the same as the note. The balance should be exactly the same. Because all the information that appears in the note appears where? In the current account. So just to revise that, why do I say that? In my current account, I could have, let's just pretend it's a credit balance. I would have a credit balance. The balance in the beginning will appear on the credit side. That's the retained income in the beginning. What is a partner entitled to? Salary, bonus, interest on capital. This will always increase his interest, his owner's equity. So there's my primary. The final distribution is calculated in your appropriation account and taken to their current account. So if they were left over at the end of the year, that would always appear on the credit side. If we made a loss, where would it appear? On the debit side. So there's your final. Drawings is always closed off to the current account. There's drawings. So at the end of the year, what do we calculate? Let's just pretend it's all positive. If he'd taken less than what he was entitled to, the balance would still be positive. Remember, the balances in the beginning and end can have a debit or credit. It can have a credit, then a debit. It can have debit, debit. It all depends. So, does everything that's in the current account reflect in your note? That's why it should balance. It must be the same if you work it out. No, you don't have to. There's enough space there. You could have written net profit as per income statement in there on top, if you're doing that format, using that format. Okay. Any question on how does the note work? Okay. Do we ever put the net profit as per income statement? Do we ever take that? Okay, let's say the net profit per income statement is in year 100,000. Do we ever take that and divide it by the ratio? Okay, it's a common mistake. It really is. Why? That's not the final distributions of profits. What must first be subtracted? All the primary. What is left over is divided as final. And then primary plus final equals net profit for the year. But we'll do it now while we complete the paper. Right, so now back to my question. What do I do with that current account, 1st of March 2014? So I hope you've completed the format of the current account. Now put those balances in. If you're not sure where, I will come and show you. It will go under retained income in the beginning of the year. If it has a debit balance, is it positive or negative? Negative. If it has credit balance, positive. Okay, here you can assume that there's no credit written there, but clearly they've shown you which one is debit. If both were debit, they would have indicated that. Right. Can we take the fixed deposit amount to the balance sheet? Yes. In brackets, write 85,000. Debtors control, they've already taken. Bank has a favorable balance. Where do we take that? So go and take it to cash and cash equivalents. Cash float forms part of what? So add it to cash and cash equivalents on your balance sheet. All of these things will count marks.
Do you write the whole amount?
Yeah. No, you can. I put it separately first. Okay. What else could we have taken? Capital and capital to the balance sheet. Write it in brackets. 850,000 and 550,000. Where? On the face of the balance sheet, next to capital. Are you keeping track, making ticks what you've already taken? Right, I see accumulated depreciation on vehicles. What does the date say? So can you take it to the note? Yeah, take it to the note. Accumulated depreciation in the beginning. And if they're given that, then it's fine. Then you don't put it in. So tick it off that you've already dealt with that. You've done that. Right, is there anything else? So can we now go to the adjustments? Okay? Yes, loan. Yes, take loan from the pre-adjustment. Good. Right. Land and buildings. If you have a look, is there any land and buildings in your answer book in your note? So what do you think on the face of the balance sheet that amount in brackets mean? They've already taken that.
That's the cost of this.
Look, land and buildings.
The cost of vehicles and equipment. Can't you take that?
No, we have to work out. Okay, so you have to wait for the adjustments. Right, let's start with the adjustments. What if there's an adjustment with drawings? So there's not a lot of space, so I always just wait a little bit with drawings. Okay, because there could have been a partner has taken something from the business, but it has not yet been recorded. So then we need to adjust it. Okay, so just be careful with that. Yes?
What were you saying
land and buildings, there's nothing in the note. Okay, so they've already taken on the face of the balance sheet. Right, have a look. First adjustment. The partnership agreement made provision for the following. Both partners are entitled to a salary allowance. Sam's salary is 1,000 per month more than Sanjar's salary allowance. Sanjar's salary allowance for the current financial year is 118,750. So they've given you the salary allowance. So take it to the current account. And I am going to show you the T account so that you can see it works out the same. So we have current account. This is just to revise the ledger accounts as well. So we started off with balances in the beginning. Right. Now, if we indicate the salary allowance, they've provided us with the salary per annum, 118,750. So how much is Sam getting per annum? Per annum, they are saying Sam's salary is 1,000 per month more. So first of all, I need to work out 1,000 times 12. So he is getting 12,000 more, but what is Sandra getting? So what is the total salary? One? Correct. Okay, be just careful in how they provide you with the information. Per annum means it's 12 months. There's the salary allowance. If they say per month, we always have to times it by 12. But now he's getting 12,000 more. So what is he earning per annum? So we have to add it to what the other partner is getting. Any questions on the salary? Right, next one. Both partners received interest on capital at 12% per annum. Note that Sandra decreased his capital by 50,000. So you need to be careful. Why? If I look at the balances, my accounting period ends 28 February 2015, which means it starts the 1st of March 2014. The one partner, Sanja, decreased his capital contribution on the 1st of December 2014. So it means the balance from the pre-adjustment is the balance at the end. So what is the balance in the beginning? So basically from the 1st of December he had a capital contribution of 850. So what was it before he took 50,000? 900,000. So interest on capital must be calculated on 900,000 at what percentage? At 12% for how many months? So it means for 3 months, it should be calculated on 850,000. Okay, be careful with this type of transaction adjustment where capital was taken or capital was contributed and it has been recorded, because it has an impact on the interest on capital. Right. So, what would be the interest on capital that he is going to get? Say again? 100% correct. So he is getting interest on capital, 106,500. And how much is Sam getting? Was there any capital takings or capital contributions by Sam? So I can take the balance from the pre-adjustment, which is 550,000 times 12%. What is the interest on capital? So interest on capital, 66,000. Next, it was agreed that Sam received an incentive bonus of 15,000 for an extra hour spent finalizing an advertising campaign. So who gets a bonus? Only Sam. He's entitled to it, so it will be recorded on the credit side. How much? 15,000. Remaining profits are shared in the ratio. So how do we find out what is remaining? Just to revise the ledger accounts. All of these accounts, the primary distributions, would have been closed off to the appropriation account. So I would have had salary, SAN, just abbreviation, was 118,750. I would have had salary, SAM, 130,750. Interest on capital would have been 106,500 plus 66,000. Why do I add it and I don't write it separately? This is what we've done yesterday, because I have one interest on capital account. That interest on capital is close off to the appropriation. So the total interest on capital is 172,500. Then we have bonus, which is equal to 15,000. Right, so this all forms part of my primary distributions of profits. So what was the total primary distributions of profits? 437,000. You will not write this in your exam, in your general ledger. It's a separate calculation. So what are we distributing? What are we distributing? Okay, so it means what was the total net profit, which will be calculated in your profit and loss account. They said to you, the net profit after taking into account the adjustments was 462,000. Now what have you noticed? They've actually made this question easy so that you don't lose a lot of marks by telling you the total primary distribution is 437,000. Those things should all actually add up to 437,000. So advice, when you're now completing your exam and you add up and it doesn't get to 437, what do? Just leave it and move on. I would actually advise, don't even add it up. It's given to you. You have to use that 437,000 to work out the final distributions of profits. So don't even add up all the totals, because number two, I'm wasting time by doing that. because it's already done for you. So why spend time on calculations which are already done? So use the 437,000. So now what is remaining? 462,000 minus 437,000 equals? And now that is shared how? In a ratio of 3 to 2, so you have to say 3 divided by 5. And for the other partner, 25,000 times 2 divided by 5, or just take the difference. So which one comes first? The name which is mentioned first. So that's Sanja and Sam. Right. So how much is Sanja going to get? I can't hear? Good. And the difference is? So I would now say current account. Current account, Sam, 15,000, 10,000. The debit side must be equal to the credit side. So appropriation. I saw there was a hand. Yes? Okay. Right. What is closed off to the current account? What do we still need to complete? Drawings. Now, there wasn't any drawings in there that they said that there was an adjustment. So what do we need to do? From the pre-adjustment trial balance, what was the total drawings? So the drawings for Sam, 45 to 50. For Sam, 56 to 50. So what is left for me to calculate? The balance at the end. So the balance at the end should be exactly the same as the retained income at the end in your note. So I'm going to give you a minute to complete that, and then we'll mark it. So take the credit minus the debit side. If it's a positive amount, then it's a credit balance. If it's negative, it means the debit side is more than the credit side. So I will write out the balance for you in here. See if you get the same answer. You should be getting the same answer. And the same with Sam, you should be getting a positive balance. So will we be testing the note and a ledger account? Does it make any sense to test both? It's 100% fine. Okay. You would have a line open if you put the net profit before tax on top. Okay, wait, we're not done yet. Are we? No, wait. No, wait. Yeah. Mark, there you go. Wait. We'll continue with that tomorrow. There's the note. You can just make 100% sure. So we have to finish this tomorrow. Any question on the partnerships, how it works? The note? 100% sure. Any questions on the ledger accounts? Income statement? Did you all get the same answer as the balances that was in the current account? Right. Thank you very much. I will see you tomorrow.